Okay, so welcome to it. This is the first lecture that we're going to be doing on the inventory and production cycle. It's a critically important cycle because it sits in the middle of all the entities that you'll be dealing with, particularly in the manufacturing sector, which is one of the most important sectors in South Africa. So we want to pay particular attention to how this cycle fits in to other cycles. We're going to do that in the first video where we look at where exactly the cycle sits. We also are then going to analyze, what are the controls that might be here. That's just a brief sort of overview. I also do have a separate video on that particular side of the cycle, so I'd encourage you to have a look at that. The next thing is this cycle is heavily affected by accounting. Particularly IAS 2, and there are some strange things that are happening in IAS 2 that we want to look at from an audit perspective. So we are going to focus in on IAS 2 in this lecture a bit more than we would normally look at it, and the reason for that is because of its material impact that it has on auditing of inventory. The next thing that we're going to look at is really the fraud and the misuse, particularly of inventory, and how that can be avoided. One of the key parts and the key things that we need to learn in these types of lectures is really the test of control, and I think students often struggle with tests of control. They are one of the two pillars really of the auditing of the cycle, and so we want to really understand and get a grip with how do we work around tests of control and substantive procedures. So let's quickly get into how the cycle integrates with other cycles. So the first thing that you need to understand is that this cycle is really sitting at the heart of an entity. Most entities that you will be auditing when you are an audit trainee are going to be manufacturing entities, particularly in the KwaZulu-Natal area or the South African area. We are dealing with mainly entities that do a lot of manufacturing. So the inventory cycle sits at the center of manufacturing entities. It is the cycle between the revenue cycle and the payment cycle. So basically the payment cycle, which is where we deal with creditors, is the cycle that produces inventory as basically its final product, and that feeds into the inventory cycle. The receipts and revenue cycle is a cycle that then sells these products on to our customers. So that decreases the inventory balance in the cycle. So we need to have a thorough working knowledge of both the revenue and the payment cycle when we start talking about the inventory cycle. If you don't have that type of knowledge, I would suggest that maybe you go back and read over your notes on the revenue and payment cycle now before you continue trying to understand and come to grips with the inventory cycle. So next we want to look at IAS 2. So IAS 2, as you know, is the accounting standard that is dealing with inventory and recording the inventory balance. One of the key things that come out of IAS 2 is this idea that we need to record inventory at the amount that we reasonably hope to receive from the sale of the inventory. Right. So the accountants give that amount an interesting name. It's called net realizable value. Right? Basically means the value that we are able to realize, that we are able to receive from the sale of this item. And obviously when calculating net realizable value, it only makes sense to take out the costs that we might incur if we were to sell any product or any good. So the calculation for net realizable value is the selling price, right? So the price that we're going to sell it for, less any costs that we might incur in bringing it to a state that it's sellable, as well as any costs we might incur to sell it. I like the fact that this definition adds less cost to completion and less costs to sell, because it then gets the student and it gets us thinking about manufacturing, gets us thinking about goods that we're making, gets us thinking about work in progress. And so I think it's important just to mull over that and try and understand that a little bit more, and maybe go back to your accounting notes and assess and reassess what exactly this means, particularly in the service industry versus the manufacturing industry versus the construction industry. How can these different concepts be applied in all of these different industries? Remember, students, that in your test or exam you will receive something that you are not familiar with. It's just, if you are familiar with it, it really wouldn't be called a test. So I think you need to become comfortable with thinking outside of the box and thinking about things and different industries differently. So I want you to try and look at net realizable value and see how it needs to be applied or can be applied in different industries. What might cause doubt about something's net realizable value? Well, if a specific product is damaged or not being used because of new technology, then we'd say that product is damaged or obsolete. Or if the product is heavily based on market prices. So if you are dealing with something like gold, if you're dealing with something like oil, where there's an active market for this, and the market is so active that the market tends to want to set its own price. So you are, as a producer, you're not a price setter, and that can lead to a particular product being considered more than its net realizable value. So we want to pay particular attention to those types of industries. So industries like mining, where they're producing gold or platinum, and these, particularly gold and platinum, are actually quite large in South Africa, and so we want to be aware of that. And so those are the types of industries we want to look out for. Industries where we're dealing with a price taker and the market is an active market and therefore sets its own price. The costs that we would probably want to include, and often students miss, are the costs relating to transportation of goods. And the idea behind this is getting the goods to the state that it is usable, right? So we want to, everything involved in getting goods to the state that it is usable, whether that means, transporting it, changing it, amending it in some way. These are all costs that we'll incur and in getting something to a usable state. And then obviously conversion costs if there's need for production. And then this is the idea that I was trying to get across. We need to get inventory in a state or a location and condition that it is usable and adds economic value, right? So those are the costs we want to try and consider, and this slide was just basically giving you a brief description and understanding of net realizable value from the audit perspective. So this is your homework. I want you to have a look at IAS 2 paragraph 16, particularly paragraph 16, and I want you to try and figure out what types of costs need to be included and what types of costs don't need to be included. So I've included a few examples here. I've said storage costs, administrative costs, selling costs. What are these costs and when do they need to be included and when do they need to be excluded? When we're talking about manufacturing costs, now this becomes important when we're dealing with work in progress, right? And I've just mentioned that work in progress is important for us. So let's have a look at this. when we talk about work in progress, we want to ensure that on our specific job card or calculation as an auditor, we have the direct and indirect materials, the direct and indirect labor, as well as the variable and fixed overheads. You would be very familiar with these types of things because you would have tackled these things in management accounting. And this is a time for you to go back and review those notes that you made on your management accounting dealing with calculation or the composition, let's call it the composition of costs for manufacturing goods. What do we do with abnormal costs? How do we treat them? You guys should know that from your studies, and so I want you to investigate that and find out how do we treat that and how would you audit it. So let's look at the cost formulas. Now, cost formulas become important because, and this is again something that auditors are missing out in practice, is you have to get the valuation of a specific item correct. And that means you need to follow the method of usage or the method that the client is planning to use a product. Therefore, we want to look at things like FIFO and weighted average versus specific identification. And I should also add here that companies are often moving away from FIFO and weighted average, and they're becoming more and more used to using specific identification, even for multiple homogeneous types of goods. So we want to try and focus our attentions on specific identification a little bit more as we move into a more practice role, because that's what's going to be looked at in practice. When we're dealing with imported goods, just like you would remember in your studies on IAS 21, the first and most important thing we want to identify is risks and rewards. When do they transfer? That means us looking at agreements that we have with our suppliers, trying to identify the shipment terms. Once we identify the shipment terms, we can then identify the transfer date. Once we get the transfer date or transaction date, it then makes it a lot easier for us to get the exchange rate. When we get the exchange rate, we can then use the exchange rate to review what we find on the invoice. Notice I didn't say agreement because we look for the transfer shipping terms on the agreement. We look for the transfer date based on what we heard from the shipping terms. But when it comes to the value of the product, we have to look at the invoice, because between the time that the agreement was concluded and between the time that the invoice was issued, there could have been a variation in price. Not only that, oftentimes agreements are concluded for groups of products, right? So a large number of products, whereas we are often dealing with individual products. So that's why I say we look at the agreement for the shipping terms, but when it comes to the amount and the date of transfer, we then start looking at other documents like the invoice, etc. So here's a question. What exactly do we do with inventory at year end? Do we have to restate inventory at year end? I mean, you guys will know very well that we have to restate things like debtors as well as creditors. But do we need to restate inventory? The answer to that is no. And that is because this is not an amount that needs to be paid in the future. The amount is basically sunk. It's already decided. There's no variability in it. And as a result, we don't restate it at year end. Okay. So the principle as to why in accounting you restate certain balances, and therefore as an auditor you need to audit it, right? So why in accounting we restate certain balances and in other balances we don't restate it. The reason for that is because of variability. There is a certain level of variability that is considered material in balances like debtors, whereas when we're dealing with inventory, the variability has been reduced to such a level that we only need to look at a lower of cost or NRV, and that test can be done at the end of the year, but it can also be done once a year and doesn't need to be done on a monthly basis. In addition, we often will have inventory that does not last for an entire year, so it moves so quickly out of our entity that we don't have time to restate it. So there are multiple reasons why, but these are the ones. So let's have a look at fraud. We've got, as you know, two types of fraud that as auditors we want to really look at. So fraudulent reporting, so where someone has told us a lie in the financial statements, and then misappropriation of assets. That is when someone has stole something or using something inappropriately. Generally, when it comes to management can commit both, so they can misappropriate assets or fraudulently report, but generally history has shown us that they generally only fraudulently report, and this happens more often than the misallocation of assets. I'm not saying misallocation doesn't happen with management, but generally it's management is wanting to fraudulently report. So as the auditor, we are looking out for these two types of frauds, and we want to then look for things like fictitious inventory that doesn't exist. Then we've got understatement of write-down, so we're looking at valuation there. Then we got consignment inventory or consignment stock that doesn't belong to our client but is being accounted for. So these are the types of things we want to be aware of when we are looking for fraudulent reporting. Remember, these are not all of the things that affect inventory. They're just some of the most important things, and some of the things that often come up. So the other thing that is important is that inventory, as well as debtors and creditors, just by the way, is closely related to tax. The clients may be changing or amending the way they treat inventory because they want to gain some benefit from a tax perspective. So you as a student need to be aware of that and watching out for that in your tutorials as well as out in practice. So in what ways can management lie to the auditor? These are just a few. And these are real life examples, things that actually have been done. You will find that if you read your textbook, there is the story of the fake oil. So what happened was there was an amendment made to the oil tanks. The auditor came, had a look at the oil in the oil tanks, and he said, there's so many millions of liters of oil here, we can sign off on this audit report. But in fact, the amendment was made in such a way that there was a little tube welded to the bottom of the entrance of the oil tank. So, and that little tube was filled up with oil. The auditor then measured that tube, and obviously the tube was full, and he thought the entire tank was full, whereas the tank was empty. So that's an example of how you can amend tanks in order to make it look like you have product but you don't. The other one is obviously if the product that we're dealing with is tasteless and colorless, it looks and sounds and is very similar to another product that we drink called water, which is also tasteless and colorless. So people can often fill these tanks up with water and make it look like they have inventory to sell. Stacking boxes high, and another thing called hollow stacking is where you stack boxes very high, but in the center of the group of boxes that you stacked, those boxes are empty. You can also put weights in boxes like bricks or that sort of stuff, or glowing boxes to the floor to make it seem like the box is full, but in fact the boxes are empty. Consignment stock, that's where you hold someone else's stock and you make it look like yours. And then obviously cut-off and pre-invoicing, so where we, for example, include things in our inventory balance that we haven't yet received. Misappropriation of assets, which is theft. We've got things that we want in place. So what sort of controls that they need to have. One of the most important things is the access controls that we want to have in place. And then in order to hide it, management might fraudulently report, right? And we call that creative accounting sometimes. Obviously, theft is dependent on, the type of good that we're working with. What are the physical controls around the goods? Where are the goods stored? What the count controls? What are the cycle count controls around these goods? So these things are all critically important when dealing with, inventory. There's specific inventory that is a very high risk for misappropriation of assets. What type of inventory items are these? These are inventory items that are high value, low weight items. So I'll say that again. High value, low weight items. For example, a diamond, right? An uncut or cut diamond. That is a high value item, but it may be extremely small and generally not very heavy. So this is an item that is very, very prone to misappropriation. It can easily be stolen. So when we look at those types of items, we want to be very careful about them. We want to be really, as auditors, we want to identify that they are high risk items. So high value, low weight items are very dangerous. Other things like gold, when we are talking about things like, TVs, that sort of stuff, those are all considered to be high value, but in relation to the value, the weight is not really that high. So those things, in comparison to, let's say, cabbages, where the value is not very high, but it can sometimes weigh a lot. So those are not high risk items. When we identify that our client is having high risk low weight items or high value low weight items, it should be triggering audit risks for us, and we want to do additional audit procedures. Ways in which we can hide theft is if we don't have good segregation of duties, and the same person that is taking care of the goods or in custody of the goods is also the same person that is recording movements of the goods. So that's a very dangerous situation, and if we have a weak control environment. We're going to be specifically focusing in on the inventory count, and this particularly is a section that often gets tested in exams, so I want you guys to pay attention now while we do this section. It is a section that is tested in exams, but it's not necessarily tricky. It's just multiple iterations of basically the same thing. So if you can get it down the first time, you will not have issues with the rest of the inventory count. So let's have a look at the tests of control. So inventory count as a basis is one of the biggest tests of control in the inventory cycle. So what is an inventory count? An inventory count is where the client, notice I mentioned the client, the audit client. The audit client goes out and counts the amount of inventory that they have on hand. So they do a physical count. They then take this physical number and attempt to agree it back to what they have on the accounting records, what we sometimes call the accounting balance, or we sometimes call it the theoretical balance. So they want to try and reconcile these two numbers, what is actually there and what's supposed to be there, or what is being recorded as being there in the accounting records of the entity. So it's first and foremost a control mechanism. Okay, so it's a type of internal control. Our job as auditors obviously is to test the internal controls, and particularly the effectiveness, the design, and the implementation of the internal controls. So as a result, the inventory count becomes very important for us as auditors. So let's now have a look at some of the stuff we want to do. So what can we do in order to assess or test the control of the stock count? We can obviously be there, right? We can observe what's happening in the stock count. Because this is a process and not a document, remember when we're talking about tests of controls, there are two broad types of things that we're talking about. We're either talking about a document, so someone has signed something, someone has counted something, someone has signed something or amended something or done a calculation, or those are documents, right? So we have documents that we can test by physically inspecting them. But then we also have on the other side a process. Process you can't physically inspect because it happens at a specific time with specific people in a specific way. So instead we want to try and observe the stock count. But there are certain documents that come out of the stock count as proof of the stock count having existed. For example, count sheets are a type of document that are a result or a byproduct of the stock count. Now, what is a count sheet? A count sheet is simply a document where the client records the amount that they physically counted. So the counters go out and count, and if they count 10, they record the number 10 on the count sheet. So that is an example of a document that gives us evidence that the stock count has happened. We can also have evidence that the stock count has happened because there's going to be a reconciliation between the physical inventory on hand and the account balance or theoretical balance that are in the GL. So that's what I'm saying here. We can inspect the different documents or reconciliations. We can also inspect that the goods are there, and if they've moved, we can inspect the transfer documents for the different goods, where they've gone to, etc. So we can inspect evidence of the stock count having existed. The next thing we can do is we can inquire of those involved in the process. So when I say inquire of those involved in the process, there would be specific counters that are counting inventory. There will be the warehouse manager. There will be the warehouse supervisor, the count supervisor that are there during the time that the stock count is being done. So we want to try and find out from these people how exactly the stock count went, what exactly they learned, what exactly they didn't learn, were there any instructions that were given to them, etc. Okay, we can then reperform not only the stock count, but any calculations or any reconciliations that come with the stock count. So let's have a look at the substantive procedures. Okay, so when we're talking about substantive procedures of a stock count, we are actually talking about what exactly the auditor does when he arrives at the stock count. So first, let's try and break up the purpose of the auditor being at the stock count. The first purpose of the auditor is to actually see the goods, actually see the stock or the inventory. When the auditor sees the inventory, he is then able to make an assessment on the assertions of existence, valuation, and completeness. Remember that existence is when the auditor is trying to test items that are on the accounting records and identify if they actually exist in real life. So that's existence. Notice the direction. We're going from the accounting records to the items. Okay, so we've got to get that direction correct. So we're going from the accounting records to the items, and that tests existence. Then if we select a random item in the warehouse or wherever the items are stored, and we attempt to test and trace that specific item into the accounting records, we're going in the opposite direction. Now we're going from the item to the record. If we do it in the opposite direction, we are then helping with completeness. Remember what completeness is? Completeness says that everything that is there actually is correctly recorded. So with completeness, we're trying to identify, has it accurately been recorded? With existence, we're trying to identify that the things that are actually recorded actually are real items. They're not fictitious. Okay, so we can assist with those two assertions. When it comes to valuation, valuation is talking about the value that is recorded on the financial statements or on the accounting records is an accurate and true reflection of the actual value of a given asset or item. Now, when we're specifically dealing with inventory, us observing the inventory as auditors, we would be able to assess whether this item is usable, whether it can be sold to a customer or client, whether it can be used in production, whether it is damaged, obsolete, or in some other way unusable. So we can then gain some sort of assurance, some sort of audit evidence on the assertion of valuation by going to the stock count. So the first part of us being at the stock count is really a substantive procedure. We want to test substantively the existence, completeness, and valuation. In addition to those ones, we can also add cutoff. We can also add presentation and classification on to those assertions. Obviously, they are tested at a lesser level though. So the first is for us to attend the stock count and actually see the inventory. That helps us to gain some sort of audit evidence on the inventory balance that is sitting in the financial statements. So that's the first thing. The next is because, and we've mentioned this already, because we are dealing with an item that is actually we're dealing with a process that is actually a test of control. What we want to do as auditors is we also want to assess if this internal control is functioning. So this is why we call the attendance of a stock count actually a dual purpose test. Dual purpose means it falls into tests of control as well as tests of detail, right? So it's two types of tests in one. So it's a very valuable part of the audit work because it gives us a lot of information. So this is why we say that it's so critical for the auditor to be there. We're testing the effectiveness and the implementation of the tests of control, and that makes it tests of control. And we're also having a look at certain assertions, and we've mentioned already things like existence, completeness, and valuation. We've also got cutoff as well as presentation and disclosure. Rights, when we're talking about rights, and you'll see rights on the slide just under B, when we are talking about rights there, what we are saying is we're trying to trace that these items of inventory or stock items are actually owned by our audit client. That becomes a little bit tricky, and it does mean that we might need to trace it back into the creditors section, right? So notice in an audit, we can't just, and you need to remember this as students when you go out into practice, when you're auditing inventory, it doesn't exist as a silo. Yes, it is an audit section and it will generally be allocated to one person, whereas the accounts payable will be allocated to probably a different trainee, but you really cannot treat it as a silo test. It has to interlink. So when we are testing rights of inventory, for example, we will want to look at what is being tested under the creditors or accounts payable section and ensure that items that have been purchased from a given supplier have the name of our client on the invoice. That means that our client now owns that specific amount of inventory. So these are things that we want to look for when we are testing the stock count. Okay, so when the auditor is attending the stock count, there are certain things or certain assertions that he wants to look at. For example, existence. We spoke about this already, but how does the auditor tests for existence. He goes from the accounting records to the actual flow of the audit client. So we go from the accounting records to the actual inventory and test that the inventory exists. When we want to test completeness, we go from the inventory to the records. When we want to test valuation, we inspect the different inventory items that are there to confirm that they are usable and not damaged or obsolete. So, as mentioned, the inventory stock count is a very important type of test. In order to get to the inventory stock count, we want to try and prepare our audit trainees as well as our audit client so that the stock count goes off without any problems, and as auditors we are able to gain as much information or audit evidence as we can from the stock count. So let's have a look at some things we can do in order to make sure that the audit of the stock count does not go awry. So the first thing we'd want to do is confirm all of the details with our audit client. That may mean that we confirm the date, time, location of the stock count. If there's multiple locations that one staff member will not be able to go to in one day, we might need multiple audit trainees to go around. We also want to make sure, so that's the first part. How do we get there? The next part is when we get there, we want to be able to test this stock count as a control activity. That will mean that we get instructions about how the counts are meant to be done. So we want to try and understand what should the internal control look like, right? So this is test of control part. So we want to try and get that in those instructions, familiarize ourselves with the instructions so that we understand what needs to happen. We look at things like floor plans, etc. If there are any stock items that should not be counted, maybe they have already been sold, or maybe they are consignment stock, or maybe they have been received but have been received after the stock count has already started. We want to understand and get an idea of these items as well. So we want to identify the stock that is being counted there. And finally, we want to train our staff if we're dealing with a particularly tricky stock count where, for example, we're counting things like gases or liquids, then we want to train our staff so that they're competent enough to deal with these things. When the stock count has started, the main key here is we must remember the dual tests that we are doing. First is we are there as an observer. We want to observe that the stock count is being done correctly. That may mean that we look at the instructions and assess what the counters are doing based on what the instructions that we were given, the count instructions. So that's the first part, ensuring that the count instructions, so the count instructions is literally a document that is prepared by the client in which they tell the counters how to act and what to count and what shouldn't be counted, etc. So we as auditors are just wanting to test to make sure that the implementation of the count instructions is happening correctly by the counters. The next is we want to try and identify any items that may have a valuation issue. So we're testing the first assertion of valuation, and that may mean we walk throughout the warehouse or wherever the items are stored, and we try and identify items that are packed away in the corner, items that are damaged or dusty and look like they haven't been used in a long time. These are items of high risk for us as auditors, and therefore we want to identify them and deal with them as soon as possible. The next is stock counts. So we are there to perform substantive procedures as well as tests of controls. So when we're doing our substantive procedures, we are going to want to test from the records to the stock and from the stock to the records, which we've already discussed. So that's what I'm talking about there, conducting test counts. Now, oftentimes there will be differences between what exactly has been counted and what exactly is on the accounting records. We want to gain an understanding of how our audit client is dealing with these specific instances. So what is the audit client doing when there are different things that are not agreeing? So that's important as well for us, is to understand what exactly the client is doing in these specific instances. We want to know how differences are being dealt with. For example, we don't necessarily want the client to just accept whatever was counted, because obviously, because we are counting generally with humans, there can be issues in terms of human error. The next is, as part of our test of control, we want to have a look at the stationery that is being used during the count. So when I say stationery, I mean not necessarily pens, but rather documents. So what types of documents are being used? For example, that we would expect that there is an inventory count sheet. What does the count sheet look like? Are people required to sign so that there is some sort of isolation of responsibility on the counter's part? So the counter is not just counting for the sake of counting. He knows that he is going to be responsible for what he counts. So those are the types of things we want to identify as auditors when we are doing the count. The next is also, when the counter is counting, we want to look at how he identifies, for example, if a stock is there. So does he look for a box? Does he pick up the box? Does he look in the box? Does he weigh items? So these are the things we want to gain an understanding of. And then finally, after the count, we may want to assess and identify what items have not been counted. So we do that by identifying blank lines or blank parts of the count sheets. We want a copy of all the count sheets, just by the way. We also want to look at any changes that are then being made to the actual financial statements based on the counts, and we want to test those changes and make sure that the changes being made are accurate. Then with regard to cutoff, so the stock count generally happens at the last day of the financial year. If it happens before the last day of the financial year, we were then going to deal with that when we talk about roll forward, right? But ultimately, there will be invoice numbers as well as delivery note numbers that are the last delivery notes or last invoices received for the year. That is called the cutoff number, right? The invoice number that is the last one received for the year. So we would use those cutoff numbers to test that there are no items included in the account balance that have a invoice number or a date that is after the year end. So this is what I'm talking about, getting a list of those cutoff numbers. We also want to test to make sure that there aren't any items that are received and being hidden somewhere. And we do that by looking for goods received notes that don't have suppliers invoices. Okay guys, so now we actually want to start talking about the accuracy of the maths involved. Now there is going to be quite a lot of maths or calculations that you will have in this audit section, because you're dealing with quantities and unit prices, as well as sometimes different types of products can result in different types of finished goods, etc. So the first thing we want to do is we want to get a full final stock listing. Final stock listing will have all of the different stock items as well as what their final count amount is for the year. Then we are going to try and reperform any extensions. That might mean, recalculating the cost versus unit or unit cost versus quantity amounts for each stock item to ensure that the actual verification of this stock listing is correct. We want to reconcile what they've actually counted versus what was on the account balances. Now that reconciliation will be done by the client, so we reperform that reconciliation. So that's what we're doing there in terms of the audit work around it. When we are looking for specific quantities, we're going to look at the quantity on the stock listing and trace that quantity back to the actual count sheets. Now that's important. So we're looking at what's the quantities that are available on the system and tracing it back to what's physically there. So there we're looking at only the quantity amount. We can also test the unit price by identifying the unit price for a given product or a given inventory item, and then you trace that back to an invoice that you received from a supplier to test that the actual unit cost, which is represented on the stock listing, is the same unit cost that it's supposed to be. The next thing that's critically important is looking for strange or unusual items on the listing. So we want to look for items that have been there for a long time. So we want to do an age analysis on it. We want to look for items that are negative. We want to look for items that are too high, unusually high. We want to look for items in which the count procedures did not cover all of the amounts or all of the quantities that are available. So they haven't counted all the stock. Why haven't they counted all the stock? It could be stored at a different location, could be consignment stock. These are the things we want to try and look for there. So when it comes to pricing now, this is what I was talking about. We always want to, firstly, when we look at pricing, identify the method of usage. When I talk about the method of usage, the popular ones that we know of is FIFO, LIFO, weighted average, as well as specific identification. So FIFO, first in, first out. LIFO is last in, first out. Weighted average is where you work out the weighted average amount or unit cost for the entire batch, and specific identification is where each one is given a separate serial number, and therefore it's easy to identify which one is being sold. Now, in this scheme of things, what you'll find is that more and more clients are moving towards specific identification out in practice, and LIFO and weighted average LIFO, FIFO and weighted average are not being used anymore in the real world, but we have to learn about it for now. So the first thing is we need to identify the usage method. When we identify the usage method, we can then easily trace back the cost, because depending on the method that is being used, we can trace it back to a specific invoice, and obviously on the invoice will be the cost. So that's what we want to do, trace specific inventory items back to the invoices that they originated from. That would mean looking at invoices that were received from the creditors. Sometimes we might have a specific type of inventory item that requires transportation. So we then trace it back to not only the invoice we received from the creditor, but also the invoice from the transporting costs. We want to try and remember that there are different amounts that compile into a given cost amount. So for example, there are transport costs, there are costs from the customer, so cost of raw materials. Sometimes there's also things like labor. Sometimes there's also things like overheads, which you will know about and learn about in costing. So we also want to try and test those as much as possible. For example, when we are dealing with labor, we are going to look at the hours that have been worked on a given item. We want to identify if those hours are reasonable, and we do that by looking at the actual timesheets or time records of the employees. How many hours did they spend working on this specific item, and then what is the amount that we pay them? So what is their wage rate? So even though we are dealing with something like labor, which is a little bit hard to conceptualize for students at times, it's the same formula. It's quantity, so hours worked, over cost or multiplied by cost, and that cost for labor we call wage rate. So it's hours worked multiplied by the wage rate, and we get the amount for labor. For raw materials, it will be units used multiplied by the unit cost, and that's what we get there. For overheads, there are different ways to allocate overheads, and you would know the different ways that we are talking about when you look at your math notes, and therefore you need to be very familiar with those types of notes when you approach auditing, particularly the inventory cycle. So I would encourage you to go back and read through your math notes about overheads and how overheads are calculated, so that you are able to audit and reperform any of the things that your clients are doing. with regard to overheads. When there's imported goods, so imported goods, there's just one added step when it comes to the unit cost. So remember, we spoke about unit cost under local goods, and we just said we're going to look at the invoice. When we're looking at imported goods, we want to firstly find out what the shipping terms is. Once we identify the shipping terms, we can then identify the date of transfer, or the transfer date, transaction date. So that's the first step. So first is getting a hold of the contract or agreement that we have with our supplier, and using that to identify the shipment terms. Once we identify the shipment terms, that will help us identify the transfer date or transaction date. When we have the transaction date, we then want to approach a financial institution and get the exchange rate, and multiply the exchange rate, notice, by the amount on the invoice. Notice I said we don't multiply the exchange rate by the amount of the contract, because between the contract being concluded and between the invoice being issued, there could have been a change in cost. So we want to look at the invoice date and the invoice amount, not the amount as per the agreement with the supplier. Right, so the agreement, we only look at the agreement for the shipment terms. Once we've got the shipment terms, we then need to look at the invoice for the invoice amount. So we multiply the invoice amount by the exchange rate on the transaction date to get our cost. But in addition to that, we have to identify any import or shipping costs. Now, with imported goods, we know that there will be shipping costs. So this is a given. We can do that by looking at the SAD documents, which is the South African import duty documents. So when we look at the import duties, it's called the SAD 500. It will have all of the shipment amounts and the shipment costs on that document. We as auditors want to look at that document because it's external to the audit client, right? Because it's issued by SARS, it's issued by the Port Authority. So as a result, it becomes a valuable document for us to use. And then finally, we want to allocate those costs correctly. So sometimes we might have things like wastage or abnormal delays or abnormal costs that we want to be careful that we allocate them correctly. So we touched on this a little bit, and I think it's important that we just go through it again. It's very important that we know the costing structure. So what type of costing structure is our client using? Now, we've got a few, but the ones that are popular and often get tested are job costing and standard costing, right? There is process costing, it can be tested sometimes, but the ones that often get tested are either job costing or standard costing. So it's important that we as auditing students learn and understand and know the costing methods that are used and how those costing methods are going to be actually applied. So it becomes critical for us to come to grips with that. So first we want to understand the costing process. What costing methods are being used and how are these costing methods are going to be applied. Sometimes there are policies and procedures that we might need to look at and analyze in order to understand that. Generally, in your tests and exams, though, we will tell you they're using job costing or they're using standard costing, and you can apply those different types of costing methods based on your knowledge that you got from management accounting. Finished goods are a little bit complicated because we have to compile the amounts. So we want to have the raw materials, direct and indirect, and again, we look for the quantities used versus the unit price. We have labor, direct and indirect. We want to look at the hours worked versus the wage rate, and then we have overheads, and the allocation of overheads can be different given the different types of allocations. So we want to make sure that that is correctly being applied, and based on all of this, we were looking for a specific theme, and that theme is called reasonability. Okay, we need to make sure that these costs are reasonable, particularly when we're dealing with work in progress, where the actual thing is not being completed. The inventory item is not completed. So we want to pay very careful attention to completion and reasonability. So what are the products that have been used versus what is the completion stage? And if these items that are being used seem to reasonably have been used given the completion state. So reasonability is very important with work in progress. Okay, so now we want to actually talk about manufactured goods, particularly around the WIP or work in progress. We want to make sure that there aren't any abnormal costs or costs that are strange being added to work in progress. In addition, sometimes there will be recoveries, over or under recoveries, that need to be allocated to this particular cost, which is actually accepted in terms of IAS 2. And if the client is applying standard costing, then an over or under recovery might be acceptable in terms of allocation into these inventory classes. Lower of cost or NRV. So like was mentioned in the last video, cost and NRV, the test that needs to be done for that is we need to understand whether our work in progress as well as our inventory is actually costed at an amount that is higher than the amount we hope to gain from selling the product. And remember, we look at the selling price minus cost to completion minus cost to sell. So obviously if the cost is higher than the NRV, we want to write that particular inventory item down. What do we need to do as auditors? We need to be able to calculate NRV. So we want to look at past invoices to identify, or the sale that has happened most close to the year end, so that we can understand what is the selling price. Then we want to look at what costs we would incur or the client would incur in completion and selling. This will help us to calculate our NRV. This may mean that we may have to look at previous job cards to make an accurate estimate of cost of completion, and we may even need to look at shipping documents to assess the cost of transport, etc., which are considered cost to sell. So this is, in fact, like we would test sales, it's a very similar type of test to what we did under the revenue cycle. This just means that we're now applying it actually to the inventory cycle. Stock obsolescence. Stock obsolescence is actually an allowance or an amount that is added onto the stock, the value of the stock, in order to reduce it for any stock that might go bad or be damaged. As a result, it is actually an estimation made by management. So it's a judgmental figure. Part of our audit procedures would be us discussing with the management to understand what they do in order to arrive at this number. So we want to evaluate management's process around arriving at the stock obsolescence. That may mean that we have to look at how exactly management assesses it and apply that assessment ourselves. So it might require a reassessment of the stock obsolescence allowance. This means we firstly want to look at whether the stock obsolescence policies were designed correctly. So do they actually achieve what they set out to achieve? Then have they been implemented correctly? So did management actually apply the policy that they say they did apply? And also, what is the data that they're using in order to arrive at these estimations? So, for example, we want to look at what were the past write-downs. How did these write-downs affect the inventory balance? What were recent events that have happened at the client? So was there a big fire? Was there a flood? These are things that would affect our obsolescence. We also want to look at any underlying data that is coming out of the market. So what is the general market average for this product that we are attempting to sell? So these are all things that we would want to look at when we are arriving and starting off our work on the stock obsolescence. Then, because again it's a judgmental figure, we can often do what is called analytical procedures. So when we talk about analytical procedures, what we're talking about there is we actually are going to analyze and look at and assess what our obsolescence is this year in relation to, for example, what it is last year, what it is at other companies, what was it in relation to the market, what was the stock obsolescence in relation to the days, inventory days, in relation to turnover. So all of these calculations and ratios can assist us in identifying markers of reasonability or, in fact, unreasonability. So we are basically looking for a marker that tells us, or an indication that management has applied the policy correctly and that the policy actually achieves what it wants to be done. And these types of ratios will assist us in determining the reasonability of the stock obsolescence. Also, when we're testing stock obsolescence, we want to look at the aging. So how old is our inventory and is it being sold? We want to look at things like what is a reasonable estimate, what do our stock count sheets tell us about any damaged or obsolete stock, and we also want to reperform the actual calculation that management prepares. So remember, management is preparing a calculation in the form of an Excel spreadsheet where they determine this amount. So we want to audit that Excel spreadsheet, for accuracy and for source data being transferred correctly. And those types of small audit procedures are all included in the reperforming of the calculation audit procedure. So now we have finally arrived at the stock roll forward. So you guys would know that as students, you love the stock roll forward. The stock roll forward comes out in any question that an examiner asks about audit plan or audit strategy. They always say, we need to perform roll forward. What exactly is a roll forward? A stock roll forward is when the stock count has been conducted before year end. Now, this is a very common practice because many entities end at the end of a month, as well as many entities have a very busy reporting cycle. And there's always pressure to get the financial statements out to stakeholders on time. As a result, one of the tactics that audit clients use is that they will do the stock count before the year end, maybe 1 or 2 weeks before the year end, and then perform a roll forward or a catch up for the last few weeks. As auditors, we don't have a preference to where the stock count is done, but for tight deadlines, it would be good for us to try and do the stock count beforehand so that we can test it and then reduce the amount of pressure that is on the audit team during the audit. So it's important that as auditors we see the value of the stock roll forward, as well as identify that with the stock roll forward there is additional work that needs to be done. Because what we are basically doing with the stock roll forward is we are picking a date before year end, and we are then saying that we want to gain full audit assurance, so a reasonable level of assurance on this specific balance before year end. That might involve a complete audit of the balance before the end of the year. We are basically moving that year end for that balance forward. Does it preclude us from doing any other work? No, because even after the cutoff date, we still have to perform work on the balances that were added, as well as the balances that were subtracted from this balance. So in our case now, we're dealing with inventory. So we would want to obtain the calculation of the roll forward that has been done by our audit client. So as the auditor, we will be utilizing and using a document which roll forwards the actual inventory items for us. We obtain that calculation from the audit client and we will then analyze it and audit it. How do we analyze it and audit it? We want to cast it, make sure that the actual document actually does add up to the number that needs to add up. But We also want to confirm and double check the logic. So are the right things being added and are the right things being subtracted? For the things that are being added, so our client will be adding purchases that they have made. For the purchases that are being added to the balance, we want to trace them to invoices. So obtain the original invoice that gave rise to this purchase, test it in terms of identifying the date, make sure that the rights remain with our client for this specific inventory, and we also want to confirm the amount and the date of delivery, because the date of the delivery obviously has to be after the cutoff date, which is the date that the stock count was done, but before the year end. We also want to then test the things that were deducted. What would be deducted? Well, things that would be deducted would be the sales. So we want to obtain a sample of sales for the period after the stock count but before year end. We want to test these items to make sure that there is an underlying invoice that is available for each and every of the sales that were made. We also want to test the delivery date to confirm that the date as per the invoice is between the cutoff date or the date of the stock count and the date of year end. Finally, if there are any errors or discrepancies that we come across in performing the stock roll forward, and just by the way, this is a notorious section in an audit that always seems to have something weird happening, we then want to investigate those and make sure that there aren't any issues arising from them. Okay guys, thank you for your time, and join me next time when we'll be looking at the payroll cycle.